Is a limited company actually more tax efficient for a buy-to-let in 2026? Or is it just a TikTok trend? Let's simplify it properly and make the decision like a professional. In this video, I'm going to break down the question every serious first-time investor asks. In 2026, should your buy-to-let be in your personal name or through a limited company if you want it tax efficient? Because the truth is, there isn't a universal best option. There's a best option for your situation, how you earn your income, and whether you're a high rate taxpayer or whether you plan to scale, and whether you need the income to live on or whether you're reinvesting for growth. I'm Wali Rahman, and I came from highly regulated industries like banking and financial services, and I applied the same risk-first rigor to property, especially when it comes to tax structure, because in an unregulated space, structure is where people quietly lose money without realizing. So I'll walk you through the key differences, the 2026 rule changes you need to know, and a simple decision framework you can use in minutes. So this is education, not personal tax advice. You need to speak to your accountant for the exact numbers. The decision isn't just about tax rate, it's tax plus access to profit, plus financing, plus admin, plus exit plan. So the core tax difference in one line. Personal name is rental profits taxed as income, and mortgage interest rates relief is restricted to the basic rate. So high rate taxpayers feel it the hardest. Limited company, well, that's where mortgage interest rate is generally treated like a business expense against profits, and profits are taxed via corporation taxes. The 2026 change that people are missing is the dividend tax rates rise. If you hold property in a company, you often extract profit via dividends, and dividend rates increase from 6th of April 2026. So that means a company can be efficient for reinvesting profits, but pulling money out personally may cost more from April 2026. Now remember, there's the whole thing about double tax reality. Company profits aren't your personal money. Company tax makes profit, then it pays corporation tax. Then you take the money out via dividends, and then you pay dividends tax. So a company is often best when you're building and reinvesting, not when you need every penny of rent to live on. Selling later, well, you need to think about CGT or capital gains tax versus corporate gains and why exits matter. So personally owned residential property gains are taxed under CGT residential rates. In a company, the gain sits in the company, and extracting that money later can trigger another layer of tax. So look, here's the practical takeaway. Choose a structure with your 5 to 10 year plan in mind, not just this year's tax bill. And if you already own property personally, transferring that into a company is not free. Transferring a property to a company can trigger stamp duty land tax based on market value in certain cases. Incorporation relief can defer capital gains tax in some business transfer situations, but it depends on facts and conditions. So look, in plain English, for many people, the frictional costs in transferring are the deal breaker, not the ongoing tax rate. So let's think about a decision framework. So look, A, are you a high rate taxpayer and using mortgages? If that's a yes, then Section 24 restrictions can make personal ownership quite painful. B, will you reinvest profits for 3 to 5 years, or do you need income now? Reinvesting favors company structures. Living off rent often favors personal simplicity. Or C, are you planning to scale beyond one property? So companies can make retained profits easier to recycle, but admin and finance complexity rises. And D, how important is simplicity and admin-light ownership? Under a company, you've got to file accounts, there's obviously filings, there's fees, but in a personal, it's generally a lot simpler tax admin. E, what is your exit plan? So selling 3 years versus holding long-term versus passing on to kids, they are all different priorities. So what should you do? Well, let's talk about 3 clean scenarios. So scenario 1, you're a high rate taxpayer, you're mortgaged, you're reinvesting, and you're planning to scale. Well, in this case, a company often is worth a serious consideration. Okay, scenario 2. Well, you're a basic rate taxpayer, you've got a small portfolio, and you need income monthly. Well, in that situation, personal ownership often stays quite competitive once you factor in the dividend extraction and admin that comes with it. So scenario 3, well, you already own personally and thinking of moving it. Well, due to the frictional costs, so do your maths first, things like stamp duty land tax, capital gains, any fees, mortgages, think about is it worth doing once you've factored all of those different costs in? So the most tax efficient structure is the one that still works when the rate shifts. Rules change and life just gets busy. Don't pick a structure because someone else online has said limited company is best. Pick it because the numbers, the timeline, and cash access all make sense for it. And remember, don't forget to consult your accountant to see what is the right situation for your personal circumstance. So if you stay till the end and you want more valuable property investment content, smash the like button, subscribe, and look out for the next one.